In this video, we are going to explain how to use the delta portion of Volland. Delta is a first-order Greek that tells you a lot of things. The pure definition using the Black-Scholes model is that it is the impact of your options price with every 1 point increase in the underlying. So if you have an SPX call that is 30 delta, zero point 0.3 delta, a 1 point in advance in SPX will increase your options value to 30 cents. Calls have positive delta and puts have negative delta. Since deltas are measured as the effect of your options price by an increase of 1 point in the underlying, a negative delta means your position loses value if the market goes up. Another rule of thumb for delta is that it represents the chance the option closes in the money, but its real application for our purposes is that it represents the number of shares of the underlying required to hedge an options position. For example, assuming an option is worth 100 shares of the underlying, which is a typical scenario, a zero point 0.4 delta call or 40 delta call will require shorting 40 shares of the underlying to fully hedge the position. Deltas of options change due to multiple factors, including the movement of the underlying itself, which is called gamma, movements in implied volatility, which is called vanna, or the reduction of days until expiration, which is called charm. As a reminder, Volland is showing the dealer's aggregate deltas. That means the customer's deltas are the inverse position. So if you see positive delta in the put section of Volland, that means customers are buying puts. If customers buy puts, it gives a positive delta position to dealers, which is hedged by selling that number of shares. In Volland, we convert all deltas into notional value. A notional value is the value of the underlying contract. This is a standard practice that helps put all the Greeks on equal terms and helps with cross-asset hedging and allocation. Also, as a reminder, if we were to look at one strike on different time frames, the less days until expiration there are, the lower the delta is for that strike if that strike is out of the money. This makes sense because there is less time for the market to reach the target strike when there are fewer days until expiration. Finally, at the end of every day, dealers must reduce their delta risk to zero. Volland Basic updates daily, so by the time it registers in Volland Basic, dealers have likely already hedged the delta position seen on the site. If you have Volland 3, Volland 30, or Volland Live, the Delta Statistic tool will tell you the combined notional deltas that need to be hedged intraday, combining new positioning, Vanna, Gamma, and Charm delta changes on all tenors. There are a lot of assumptions built into that number, and you don't know how much was hedged already when you see that number, but it is the best approximation of how many deltas need to be hedged from the beginning of the day. What you see in front of you now is my delta workspace. Starting at the top left, you will first see the aggregate delta exposure by strike. This is a histogram of the deltas at each strike. Positive delta means dealers are short puts or long calls. When I click the three dots and click Edit to edit my workspace, you have the choice to change the underlying, down select to certain expirations, or down select to puts or calls only. To the right of this chart, you will see the cumulative deltas. This is a flat line. Because being a first order Greek, the accumulation to the right or left of spot is meaningless. So this is just a flat number on this indicator. However, you can also change the underlying down select to certain expirations or down select to puts and calls here as well. To the right of that chart is the aggregate gamma statistic. This shows both the aggregate gamma and aggregate deltas that need to be hedged since yesterday's close. While you cannot determine how many of these deltas are already hedged as the day goes on, it helps give a direction of overall dealer hedging based on all sources of delta change. Moving to the bottom left here, you will see the aggregate total delta trend for all expirations. This gives an idea if aggregate deltas are increasing or decreasing on a daily basis. Moving to the right, this widget gives an idea of how much premiums dealers are collecting, which means sold options for dealers, or paying, which are bought options for dealers, for their positioning that day. This is separated by total premiums and 0 DTE only. Finally, to the right of that widget is the ticker statistic widget, which gives the underlying price, volatility, and equity notional traded here. Also, there's the total hedging required since the close of the last trading day, including hedging from volatility movement. here. This Volland Delta workspace does a very good job at determining changes in position overall. But because it is tough to determine which deltas are hedged and which are from Vega and therefore warehoused, the comprehensive look at delta hedging required has not shown in our studies to have much correlation to markets. Volatility related Greeks have had much better correlations, but when watching deltas, it does help determine how customers and dealers are positioned in the market, and therefore it gives context to some of the other dealer positioning Greeks, customer hedging, and market weak spots, and help with trade decisions. Thanks for watching this video, and may Volin help you find success in your trading ventures.